Welcome, everybody. My name is Bob Klepsis. I am president of All-Star Financial. Many of you who are clients obviously know me. Those of you who are not clients, I welcome you to our second ever webinar going over the third quarter 2010 All-Star Financial Review and Preview. We also do a newsletter that is outlined very similar to what we're going to go through today. So if you have a newsletter, this is going to reinforce that newsletter. If you do not, it'll give you a really good insight to where we think the economy is going, the market, and what we're doing to make sure that we meet our clients' goals and objectives. Last quarter we did the webinar, and it's surrounded around the idea of our economic macro modeling that we do based on economic cycles, and placing us on placing you on a map of where we're at economically. And that economic map, when we look at whether it be a recession to stabilization, we believe right now we're fairly closer to 8 o'clock than we are to 7 o'clock. 6:30 of 2010, we really believed we were fairly close to about 7:30. Had a little bit of hope in there, stabilization in the economy. The one thing that we mentioned is that we're not going to see a real big growth of the hockey stick going up. It's going to be more sideways for a period of time until we have some issues get resolved. And as a consequence, we're going to have patience. So normally in this situation, we'd be closer to 9 o'clock right now, but we have probably only moved about half an hour, 15 minutes on the clock to maybe 7:45. So patience is going to be key, because when we look at the economic scenario out there and the market scenario, even though the recession's over, it really doesn't feel like it. We have a significant number of people unemployed still, very close to that 10% range number, and we really have a lot more volatility than we've ever had before, and obviously that's because of the uncertainty that we have as far as how long will this economic market go sideways. And again, that's predicated on answering a couple questions, and that number one is, when do people go back to work, and when do people start spending? Risk of a double-dip recession, still unlikely, we believe. There's probably a 33% chance or so, is believed by most economic foresight. We don't believe it's probably that great, and we think the market or the government will step in a situation to not let that happen. So when we look at the economy itself, and you say, what has the government done? Well, that benefit of the stimulus package that we've seen is really starting to fade. We're seeing about a 2 to 3% growth in 2010. 2009, actually, we saw a little bit better growth than that. So we need to have consumers pick up the pace, or have the government come back in and do a little bit more of a stimulus. We would prefer more of a economic modeling for the long term. Unemployment's still a big hurdle. When you want people to spend, they need to be employed, and that comes from confidence. And we get confidence back, in the businesses will start to employ people, and consumers will come back to their spending habits. Looking forward on the economy, we really believe that it's going to be long, slow, gradual. We'll have upturns like we did in the first quarter, a downturn in the second quarter, another upturn third quarter. Some pretty good numbers here so far in the first week of the fourth quarter. But again, it's going to be more lengthy and more slow and gradual when it does start to recover. So again, creating the right expectations is important. We feel like there's really three different issues that could throw the equation sideways or a wrench into it, and that's earnings reports. We're looking at earnings reports already now for this quarter lowering their forecasts, so people aren't as disappointed. We have midterm elections that could change the power in the Senate and the Congress, and that obviously could do things if we don't change that could obviously have an effect on the economy and the perceptions of the consumers. And then holiday. Holiday is probably in the holiday sales, whether it be hiring for holidays, the rush, Christmas buying, or the spending of the consumers, makes a big play in our overall economic model on an annual basis. So in the fourth quarter here, those three things, earnings, elections, and holiday sales, could make or break this continued long, slow, gradual recovery to continue on an upside, or maybe even turn it down a little bit. When we look at the bond market this last quarter really was pretty good again. Can it continue? I doubt it. Interest rates go down, bonds go up. We've seen interest rates now pretty much at its lowest point in its more recent history, almost 40 years. So can we have another great quarter? I doubt it. The quarter was really highlighted by and benefited those who took the most risk, so credit-related sectors such as high yields and emerging market bonds really did the best. Going forward, as we've already talked about, we don't think the bond market has a lot of upside potential because interest rates don't have any more room to go down. We think they'll remain low, however. We don't think that opportunity to increase interest rates is going to be there for a while. So generating yield is going to be pretty easy. Downside risk, not that great, but upside potential is pretty limited compared to what we've had the last 18 months. Emerging markets, however, look very promising. So again, one of our responsibilities to you is to go out and find those areas that do give us growth potential and do have favorable interest rate environments and cycles of interest rates. And last but not least, everybody's talking gold. Gold is a hedge against a lot of the concerns right now of valuation of the dollars and currencies. We really don't see that as a long-term concern. It's more of a play short-term on fears. And for that reason, we don't think gold is going to be a good hedge today or tomorrow. Now, as a trading vehicle making money short-term, it's obviously been very successful for a lot of people recently. But again, long-term, managing and hedging your portfolio for risk, it really doesn't fit in right now, unless we are trying to speculate. Domestic stock market, resilient beyond belief. It had a nice jump of value side of the market went up about 10%, growth went up about 13%, even against the odds of the economy still struggling and unemployment still high. Mergers and acquisitions helped the activity a little bit. There's more liquidity in that side of the market, which helped boost interest rates. Looking forward, the domestic stock market, I think, has some good upside potential. When you look at low inflation, low interest rates, and low valuations relative to historic norms, we're still there. All we need right now really is the growth side of the equation. So that's really the big question for us. If we can get any type of growth potential, if businesses do start to hire, we could see the market consistently give us 10 to 12% total return for the next couple of years. If the market does go sideways, and indeed has a very good chance of going sideways because the market is or the economy is going sideways, where do we make money? And really that's in the international side of the world. And we've really turned our exposure up on that. Our growth portfolio, as an example, has about 37% domestic exposure and about 35% international exposure, so we're almost 50-50. Overseas returns up sharper than the domestic, somewhere between 15 to 21%, so certainly outpaced the domestic market drastically. And about 70% of our international exposure right now is emerging. Should we go higher than that? We don't think so, because there's obviously concerns emerging market-wise with the BRIC nations, Brazil, Russia, India, China, and Korea, that the established countries of Europe and Japan don't have. But what Europe and Japan don't have really is the growth, and we'll talk about that in a second. So looking forward, we're going to continue that emerging theme, go where the growth is. How do you make money in today's market sideways domestically? You don't put all your money there. You put some into the international worlds that are growing faster than ours. and understand that because of Europe and Japan's debt burden, they're going to have slower growth. And we've lessened our exposure there to about 4% exposure out of our total international exposure. So in summary, just want to quickly state that biggest issue still is the economy. And I'm not sure who said it in one of the last elections, but it's the economy stupid. That's going to get you into the White House. Housing obviously is still a concern. There's unemployment, and business hiring has to come to the forefront to be able to see the economy start to expand. And consumers, again, going hand in hand with employment, need to start spending, or spending at a point that's significantly higher. For the third quarter, our asset allocation really held firm. We really believed and said this in our last webinar that we were in a really good position coming into this quarter, and we were right with our overexposure internationally and overexposure on the emerging market side. It's really exactly what we should have done. We do have going forward a slight tactical cash position along with the bond exposure that's ready to move into equities when we believe things happen. That's going to give us a better long-term growth potential, particularly domestic. And that's when business starts to hire. Well, I think we need a government program. We've talked to you a little bit about the government program in '82, which Reagan brought out, that in similar to dollars today, it was a $40,000 salary, you'd get a $15,000 tax credit, so your net cost was about $25,000. Well, I think that's an incentive to hire. I hope that comes to fruition. Housing, we need a reduction in inventory there. We need another government program to be able to do that, to incite those first home buyers to get that done. Hopefully that'll happen. And then I think that consumers will spend in the long term. Will they spend at the rate that they did in the late 90s and mid 2000s? Probably not. But again, that's something that needs to come back before the economy domestically is going to have any type of big growth spurt. So while we're focusing on volatility and managing volatility in the sideways market, has it worked? And I think that's really the big question. Does it pay off to focus on having less volatility? And the answer for us is unequivocally yes. When you look at our returns for our income portfolio, as far as returns above the return we should have got for the risk we took, which is the definition of alpha, it's 4.3% per year more than we should have. On our balanced portfolio, 2.7%, conservative growth, 2.1%, and almost 1.6% on our growth portfolio. So all four portfolios creating significant value per year. If you look at it on a total return basis for 3 years, that's somewhere between 4.5, 4.6 to 12.5% rate of return, better than you would have got had you had your money in a Russell 3000 index. So again, bringing a lot of value to the table. We want to thank you for your continued trust in the All-Star team, and make sure that if you do have questions, give us a call. If you would like to send this along to anybody, there's an easy tab on our website that pass it along. We're also on Twitter and LinkedIn. So those of you who are active there, hopefully you're following our information that we're sending out there on a weekly basis. So appreciate the confidence you have with All-Star Financial, and do not hesitate to give us a call if you have any questions as clients, or if you're potential clients listening to our webinar. Thank you for spending the last 14, 15 minutes with us, and we'll look forward to hopefully meeting you sometime soon. Have a great day.